Bill Keogh from Fig Securities in Sydney joins us now. Bill, curious to get your thoughts. You know, we've seen the RBA leaving interest rates on hold at 4.75%. This is the most protracted pause that we've seen in quite some time. You know, what does this mean for deposit markets?
Yeah, good morning. Well, for the deposit market, from your previous presenters, we're in the same court saying that the cash rate is going to be 4.75 for the foreseeable future, and you can see that the expectation across the yield curve is very flat. I mean, you've got cash at 4.75. You have 1 year bank bill rates at just over 5. So it's a very flat, it's a very flat yield curve. So we're still seeing a lot of demand for term deposits, really from 6 months out to 1 year.
So what's still driving those calls?
Well, you've seen in the media that households are still saving. So households are actually saving 10% of their gross income, which is the highest level for 20 years. And I suggest with the underlying volatility in the other markets, such as the share market, that cash needs to go somewhere. So the driver is still from the investor side, looking for attractive rates, which is the term deposit offerings from the banks at the moment.
So this conservative consumer, this conservative Australian that we've seen, do you think that we will continue to see this phenomenon? I mean, how long can this last, especially when interest rates are on hold for the 5th consecutive month?
Yeah, well, look, again, if I have to look at the statistics, I have spoken about in previous interviews that we have seen a flight to safety, and we think that it will continue. A research house, Life Plan for Life, put out some statistics this week showing that in the last quarter of 2010, in the fund management sector, excluding cash, 150 odd million came out of that sector. That was a massive increase to the previous quarter, where there was actually an 87% increase of net outflows. So you're thinking, well, where's that cash actually gone? And again, given the volatility in the first quarter this year, that's probably going to be similar sort of numbers, and that has to go somewhere. And certainly from our side of it, we're seeing a lot of demand. We're taking a lot of calls every day for term deposits.
And I suppose that the banks would be happy if that trend continues, of course, because there is still concern out there about the cost of offshore funding. I mean, what's the latest on that?
Well, the cost of funding, well, again, if I look at what's been in the media, especially today, KPMG brought out a paper on the expectations of funding over the next few years for the banks, and the concerns there were, which is nothing new to our market, is firstly the heavy reliance on offshore off global markets. Secondly, contagion risks. So the Big Four have similar funding models. They have a dominance in that area. And the third point is that of total loans from the bank side, over 60% are reliant on actually lend money to the residential market. So what's all that saying? It's saying that probably not a lot's got to change for the funding requirements of the banks. And even if you look from the NAB side, Cameron Klein is suggesting that their wholesale funding requirements will double in the next 10 years to 300 billion. So you have a massive demand for funds. So the question is deposit market, is term deposits going to be part of that funding books? And I suggest it is. I just can't see any other argument against that.
So if I'm a retail investor and I'm looking for a place to put my money today, where am I looking? What kind of returns can I expect to get?
Yeah, sure. Well, look, if you're actually, I think what is quite attractive at the moment, if you're looking at short-term investments. So you say, look, I'm going to sit on the fence for 6 months. You can get a great rate of above 6% for 6 months. So the underlying benchmark bank bill is 5%. So you're looking at 1% plus for a return in 6 months. So I think as far as risk-free goes, that's a very attractive rate.
All right, we'll have to leave it there. Thanks so much for joining us, Bill. We do appreciate your time.
Yeah, thank you.
That's Bill Keogh from Fig Securities, and he was at the rooms at